Before we begin, just a quick note. This material was prepared by Samir Al-Rishani with some AI support. Okay, let's jump right in. Welcome. Today, we're going to demystify a really powerful, but let's be honest, often confusing part of Canadian tax law, the lifetime capital gains exemption. We're going to break it down so it's easy to understand, but also give you the details that actually matter. So let's just start with the main event, the question that gets everyone's attention. What if you could save up to $200,000 in taxes? And I'm not just throwing that number out there for effect. For a lot of Canadian entrepreneurs, this is a very real possibility, if they play their cards right.
Okay, so how on earth is a tax saving that big even possible? Well, to get there, we first need to get a solid handle on what this exemption is all about.
So what is it really? The lifetime capital gains exemption, we'll just call it the LCGE, is basically your own personal tax shield. It lets you sell a very specific kind of asset, make a huge profit on it, capital gain, and pay zero tax on that profit, all the way up to a lifetime limit. And you can see here, this isn't a new idea. And the limit hasn't just sat there. It started at $500,000 and has grown quite a bit over the years. Then in 2015, the government even started adjusting it for inflation every year. This tells you that this is a serious, long-term policy designed to reward people for investing in key parts of the Canadian economy. So the big question is, who gets to use this thing? Well, it's not a free-for-all. The Income Tax Act is very clear about who qualifies, starting with the person themselves. The rules really start with two fundamental pillars. They're straightforward, but they are absolutely non-negotiable. First, you have to be an individual human being, not a company. And second, you have to be a resident of Canada for tax purposes at the time you make the sale. This table here lays it out perfectly. The LCGE is a tool specifically for individual Canadian residents. A corporation, no matter how small, can't claim it. And if you're a non-resident when you sell, you're out of luck too. It's a very targeted incentive. Now, meeting those personal rules is really only half the puzzle. What you're selling is just as important. You can't just sell your stock portfolio or the family cottage and expect to use this exemption. It doesn't work that way. The law is incredibly specific. It narrows it down to just 3 types of property. You've got qualified farm property, qualified fishing property, and the one we're going to zero in on today, qualified small business corporation shares. And while farming and fishing are obviously vital industries, the category that really impacts most entrepreneurs and investors is shares in a qualified small business corporation, or QSBC. This is where the exemption becomes a powerful engine for business growth. Okay, so what makes a share qualified? Well, honestly, that's where things get complicated. There are a bunch of complex tests about the company's assets and how long you've owned the shares. We'll get into those details in a future explainer, but for now, just know it has to be a specific type of Canadian private company that follows some very strict rules. All right, let's bring this all together. Let's say you're a Canadian resident and you're selling shares that actually qualify. What does the payoff look like? Let's go back to those big numbers we started with. The exemption allows you to shelter a capital gain of over $800,000 from tax. And let's be crystal clear, that's not the price you sell the shares for, that's the profit, the gain you made, that is completely 100% tax-free. So what does that actually mean for your bank account? Well, that tax-free profit translates into massive tax savings. Depending on where you live in Canada and your tax bracket, you could easily be putting an extra $200,000 right back into your pocket, money that would have otherwise gone to the CRA. This brings us to a really common question, and honestly, a dangerous assumption. If you sell shares in any old Canadian private company, does that mean you automatically get to claim this? And the answer is a huge, resounding no. This might be the single most important thing to remember. It is not enough to just own a small business. The shares themselves have to pass all of those technical, rigorous tests to be considered qualified small business corporation shares. And please, don't ever forget the very first word in its name, lifetime. This isn't something you can use every year. You get one cumulative pool of exemption room, and once you've used it up, that's it. It's gone. This is a one-shot deal. Which really leads us to the ultimate takeaway here. You've got these incredibly complex rules on one hand, and the fact that it's a once-in-a-lifetime opportunity on the other. That means the stakes are unbelievably high. There are no do-overs. You have to get it right the first time. So, what's the bottom line? Look, understanding these general principles is a fantastic starting point,
But actually navigating and claiming the lifetime capital gains exemption is not a do-it-yourself project. When there's this much money on the line, you absolutely need to work with a qualified tax advisor. It's all about making sure you get that one chance and you get it right.